Good afternoon, everyone. So here I'm presenting a paper on the responses of firms to tax, administrative, and accounting rules. It's joint work with Zareh Asatryan, who is at the University of Mannheim. I'm based at the ZEW Mannheim. I want to start with two general observations on the current research on this firm responses to taxation. One is that it's very concentrated on developed countries. The second one is that it's very concentrated on firm responses to taxes and not necessarily on other tax instruments like tax administration. So to give you a bit more background on what we mean by the differences between developed and developing countries, especially in taxation. So generally, the developing countries have much lower tax revenues. On average, it's something about 16% versus 27% of GDP in developed countries. And strikingly, this is about constant. This has been about constant over the last 30 years. Another thing is that developing countries tax much more the sort of the easy taxes. This would be the consumption taxes, for example, the VAT taxes or the excess taxes. They collect much more, 29% of tax revenue versus 17% in the developed world. If you look at the corporate taxes, it's not big differences, but when you look at social security and personal income taxes, there is again a very large gap between developed and developing countries. Another observation is that developing countries probably have less progressive and narrower bases, but in both cases, the important remitter of taxes are the firms. And what is the same? The need for rigorous analysis. Here is a graph of tax revenue to GDP, depending on per capita income. And you see that upward trend for generally tax revenues to GDP. But when you restrict it to the sales taxes, what we call the easy to collect taxes, this would be the sales taxes and the VAT taxes, you see the opposite trend. So the lower income countries, the poorer countries, generating much more of their tax revenue, here about on average 40% of their tax revenue from those taxes. Here's more evidence that taxes might be more important in developed countries, while tax administration could be more important in more developing countries. This is the BIP survey of firms. And in one wave, they ask, what is the major obstacle to your business? Are the tax rates or the tax administration? And again, you see that different picture. So for the higher income countries, firms in higher income countries think that tax rates are the major obstacle for their business. If you look at tax administration, again, you see that different picture. One explanation potentially for this could be that, and we hear the story a lot in debates, that developed countries have much better tax administrations. They also put a lot of tax effort in their tax administration. So one way to measure tax effort would be to look at the expenditures countries spend on their tax administration or the staff per thousand population they have in the tax administration. And when you plot that again versus per capita income, you don't really see striking correlation with income. So here are the conceptual questions. We will not answer all of these questions, but still for motivation, I would like you to think about this. So again, the tax literature is very concentrated on the responses on taxes. I can refer to this as the ETI literature, the elasticity of taxable income literature. However, as I said, there are different instruments, right? There are the enforcement, there are compliance, there are accounting, there's information, and we want to extend this literature to look at this other administrative policies and how firms respond to that. A very good example to think about this is the tax evasion. So there is this presumption that tax evasion is bad. Of course it is bad, and it should be zero. But on the other hand, if you think about the costs of enforcing taxes, there are substantial costs involved. Cost of auditing, compliance costs for the firms. And so if you think about the costs, you can think about a trade-off where maybe there is some kind of an optimal tax gap. And tax evasion shouldn't necessarily, the optimal tax evasion shouldn't necessarily be zero. Okay, this has been lately called the tax system approach, and there's a book by Slemrod and Gilliter where they talk about optimality not only of tax rates, but about the tax administration. So now I switch to the paper, the more specifically what we do in the paper. We have very nice data from Armenia. We have the tax returns of corporate firms from 2007 to 2013. We have about 10 to 15,000 firms every year. And nicely, we have not only their tax returns, we have some characteristics about the firms, but we also know audits. So we know whether the tax authority has audited, if the tax authority has audited the firm, and if they found some tax evasion, we also know this. So we will be looking at three things. One would be the VAT registration threshold. This is a very common policy in a lot of countries, where it depends on the size, on the income of the firm, and once you pass the threshold, you have to register in the VAT system. So first we will look whether firms respond to this VAT threshold. Second is an administrative notch, where the frequency to file and pay the value-added and corporate income taxes declines from monthly to quarterly. This is set about $200,000 in Armenia, and the VAT registration threshold is something around $140,000 in Armenia, and this is quite high. The third policy we will look at is this international financial reporting standards. Again, once you pass certain threshold, it's about 220,000 USD. Once you pass the threshold, you have to comply with those IFRS rules. If you are below that, you can use more simplified accounting rules. So to give a preview of what we find in the paper is we find a very strong response to this last accounting notch. We have a moderate response to the administrative notch, and generally no response to the first VAT threshold. And then in the second paper, in the second part of the paper, we will look at how firms respond to this. This is an important question, whether there is a real response or whether the response is driven by underreporting of income. Okay, so here some context on Armenia. The tax revenue to GDP is generally low. It has been around 15%. It has been increasing. The donor organizations are very happy with that last increase, but that's from technical change of reclassifying some of the income taxes to social, the way around, some of the social security taxes to an income tax, and then you see that seemingly increase in tax revenues. Typical to a lot of developing countries, the VAT generates almost half of tax revenue. Second by importance comes the corporate income tax, then the excess taxes, and only then the personal income tax. If you look at a typical developed country, like let's say Germany, they would generate almost half of their tax revenue from the personal income taxes. Some more background. We have the corporate income tax, which has a flat rate of 20%. The VAT has a standard rate and a second rate of 0 on some exempted goods. And then we have the VAT registration threshold, which is about $120,000. Here is VAT registration thresholds around the world in 2014, and you see Armenia has one of the highest thresholds. Here, for example, Latvia, and a general pattern here is that the lower income countries are on the top of the table, and the higher income countries are on the bottom of the table. Okay, here is the tax schedules that we are going to look at. We are first going to look at this VAT threshold, which was introduced in 2009, partly motivated by the major crisis that hit Armenia. I think we had a drop of GDP around 16%. I think that was the second worst in the world. So they did that policy to relax the compliance costs for the smaller firms. Then we are going to look at these two administrative thresholds. One would be the frequency of paying and filing returns, and the other one would be the accounting rule. It was set at 60 million AMD, that's about 120,000. And then in 2009 reforms, they increased it to over 200,000 USD. There are other interesting rules in the tax schedule. One is this large taxpayer unit. Once you are below once you are above a 1 million USD threshold, you get into the large taxpayer unit, and then there's the financial statements mandatory threshold. Okay, I said that. We have this administrative data from Armenia. Here are some sample statistics. Most of the firms in Armenia are trade and services. There are also limited liability companies. An average firm would have 32 employees and would have an income of about 800,000 USDs. So again, we have three kinds of data. We have the tax returns, where we can see the income and all the deductions and so on. And then we have some basic firm characteristics, like their age and number of employees and their industry. And then we have this tax audit. In Armenia, there is this policy that the tax administration every December has to publish a list of all the firms they are going to audit in the next year. So we know that. We know that what is the result in terms of whether they found some tax evasion, and we know the exact amount of this tax evasion if it was found. Here's the size distribution of firms. It's to show that we are concentrating on this first bar. That would be the firms below 200,000 USD. Okay, so the response to the VAT notch, 0 would be the VAT notch. That's, again, 120,000 USD. And then we plot the frequency of firms within some bins of 2,500, 1,000 AMDs, and see no response around the notch. If there was some response, we would expect some increase in the frequency of firms, so that they either really or by underreporting their income come from that side of the distribution and bunch here before the thresholds. We can split the sample into firms registered in the VAT system and those not registered in the VAT system, and see that for firms below the thresholds who don't necessarily have to register for the VAT, there are still about 40% of firms still decide to register for the VAT. Here we split the sample by sectors and don't find any responses also by sector. Here are the input to turnover costs for two sectors, the construction sector and the trade sector. The idea is that in construction sector, you add a lot of value added, while in the trade sector, you have lots of input costs. So it could be that those firms who have a lot of input costs have higher incentives to register in the VAT systems, because once they are registered, only then can they claim their VAT on inputs. And so we can plot the size distribution of firms for these two subsamples. And again, don't find any effects there. This evidence is somewhat in contrast to what others have found. There are papers on the UK, on Japan, on Finland. There is also some new work from developing countries, South Africa, Ghana, I think Kenya, where people find large elasticities at this VAT registration thresholds. We don't have sort of a waterproof evidence why this is the case for Armenia, but our interpretation is that the VAT threshold in Armenia has been set so high that at this point the compliance cost of firms relative to their size is sufficiently low. Now I turn to the administrative notch, and you see here again striking this strong bunching at the administrative threshold. So it's again, before 2009 it was 60 million AMD, and then it was increased to 100 million AMD. We normalized that to 0, and we see the firms, for-profit enterprises, responding to that threshold. As a placebo of sorts, you can look at the state-owned firms and don't find anything there. We can also look the dynamic way the firms respond. So the threshold was introduced in 2009. So in 2008 there shouldn't be any response. in 2007 and 8 the threshold was here, and after 9 it was there. So what we should see is that after the reform, firms should debunch sort of here, and then bunch here. And this is exactly what we observed. You see firms slowly adjusting their income and bunching to the 2000 to this administrative threshold. That also suggests that there must be some frictions going on where firms cannot immediately adjust, but have to learn about the policy and other frictions. And that is the overall distribution for the years. Now we use this bunching estimate. Here the idea is to look at the excess mass of firms bunching at this threshold, and from that come up with an elasticity of the response of firms to that policy. The B is a number that compares the excess mass of firms. So here is the counterfactual distribution. Had there not been such a policy here, what it does essentially is to take out these bins from the distribution, estimate the counterfactual, and then compare the firms, the number of firms that are located above to the ones located below that counterfactual. And then B1.2 gives a number which means 120% more firms are there had there not been such a policy. There is the famous IS paper. They do it for the ETI, so taxes, where they show that you can use that statistics as a sufficient statistic approach to calculate the elasticity at the ETI. If you remember from the beginning, the two administrative, the frequency of filing and the accounting thresholds were coinciding exactly at the same threshold. But there is another thing that firms with 5 or less employees can still use the accounting rules. So we can use that to distinguish between the two and see whether the response is for the accounting rules or for the frequency of filing rules. And we don't see a significant bunching here, looking at the errors, while we see a significant bunching to the IFRS rule, to that accounting rule. We can do a number of placebo tests if you want. We can divide the firms according to whether they are growing or shrinking. The expectation here would be that shrinking firms should not respond to that threshold, while growing firms should respond to that, and we find evidence for that. We can also divide them by sector. Interestingly here, again, you can take the public administration firms as sort of placebo and don't find any effect there, while for others, you see consistently that respond. Now, from here, ideally, we would like to have a number, an elasticity of the firm, characterizing the firm response to these reforms. However, contrary to the tax literature, you have to have some number of how costly this reform is. And this is not easy, so we took some estimates from the literature. So, for example, if you assume that the elasticity of firms is about 0.5, then it must be that the share of compliance costs in gross income would be in that range. But again, because we don't know what is the share of compliance costs in gross income, and the second parameter, which is the change of compliance costs, once you cross the threshold, since we don't know that two parameters, we cannot precisely estimate an elasticity here. Now I come to the second part, which is to understand what are the mechanisms behind the response. Is it true response? Is it a real response? Or, on the other hand, whether it's tax evasion, so income underreporting. So we have this audit. Here we take the audited subsample, which would be around 20% of all firms that have been audited in the whole period. And we would plot the additional income that the tax authorities found during the audits as a share of gross income. You see that on average it's something like 5% of gross income that firms audit. But those firms that we show in the first part that are bunching have a much higher evasion rates. It jumps from about 5% to something like 10% of gross income. We can also do this for the full sample and not only for the audited sample. And the reason here is that audits are non-random. You could say that, okay, the tax authority knows this, and they probably target the firms who have higher incentives and opportunities to evade. And so doing this, but still we find that the tax evasion for those responding firms is much higher. We can, again, do all these placebos, looking at growing and shrinking firms and find consistent evidence with our expectations. We can look at the different sectors and see that the usual suspects, sort of the trade firms, have much higher, almost 20% evasion rates. And then we can also plot the total amount of evasion. So that would be not only the number of firms, so the frequency, which I showed before, but also the income. That should show the overall size of the evasion. And then we can also look at the reported income, so bunching at the reported income, and then correct that number for the detected income, and then do the bunching exercise again. If there was perfect compliance after an audit, you should see a flat line over there. But our audits are not perfect, they don't find everything. And therefore, you still see some bunching. But from here, we have some back-of-the-envelope calculations where we can compare these two numbers and come up with a figure which explains how much of the response is due to tax evasion. And that figure is 70%. In the last two slides, I will show you some more things on the audits. So you can say, again, that audits are non-random, and so you cannot interpret these estimates as causal. So what we do here is that we look at the probability of being audited. It's about 20% for these very small firms. So every fifth firm every year would be audited. For the larger firms, it goes up to 60% and more. And then you can look at some other characteristics along the size distribution of firms, such as the reported income or the deductions, and do not find striking differences between the two groups, the audited and the non-audited groups. In the paper, we have many more such graphs showing that these graphs are not significantly different from each other. This is the last slide, and it shows what happens what happens to firm reporting after an audit. This is the nice thing about the administrative data, is that you can estimate things very, very precisely. So even when you take the 99% confidence intervals, this T would be the year of the audit, and we want to see what happens to reported income after an audit and the reported deductions after an audit. Before that, we don't see any effect, so meaning that there is no selection. It's a precisely estimated zero, meaning that the tax authority doesn't select the firm to be audited based on income and neither on their reported deductions. What is very interesting here is that you see that after an audit, firm responds and reports about 10% more income, but they increase their reported deductions even more. So at the end, the effective tax rate or the tax rate that the tax authority gets doesn't really change. In the first year, it's even negative. So they increase their reported income by something like 9%, but the deductions by about 10, 11%. So they match the increase in income with more deductions. You see a bit more response in income in the second year and less in deductions. At the end, it's something like every additional dollar of more income is matched by something like 95 cents of more deductions. Okay, the last slide, I conclude. Unlike in many developed countries, we don't find a strong response to the VAT notch. We think this is because the VAT threshold in Armenia is set sufficiently high. What is new in this paper is that we find strong response to administrative notches, such as the accounting notch. And then we show that most of the response is due to evasion and not real responses. At the end, I want to leave you with a small puzzle, which is that we think about evasion in a traditional Baker style as being a determinant of the probability to be caught, the penalties, the marginal tax rate, and risk aversion. So if you assume that risk aversion is more or less constant across countries, and the probability to be caught is extremely high, it's 20%, the audit rates are 20% for small ones, but they go up to 60% for the large ones, it has to be something else. And my interpretation is that despite of the very high audit rates, these audits are not efficient. Or in other words, they may be corrupt. Thank you very much.
We do have time for questions, so the discussion is open.
Thank you for the presentation. You mentioned penalties as standard. What kind of size of penalties are we talking?
To be honest, I don't know.
Any other questions?
Whether the results are sensitive to the difference in just having an audit and being caught, basically. Because I suspect that there should be many cases when auditor comes, finds something, then you bribe him, and then he says, that's fine, there is no evasion. Thank you.
But this is something we cannot capture in the data, right?
But do you only see the fines? I mean, you can try to use these two different measures, whether you were audited and whether you were fined as substitutes to see if there is a difference.
So all the figures I show you with the extra income found during the audit, they also include the penalties and the fines. So that goes a bit back into your question. Mm-hmm. Yes, these are including the fines.
Okay.
Any other comment or question for Zareh?
Just a quick clarification, I don't think I need that. 20% of auditing is quite high. It's not annual, it's the whole period of your data, right?
It's annual.
It's annual?
Yes, every year.
Well, that's really a lot. I must take quite a lot of resources.
Right. Yeah.
And what about the cost effectiveness? Has it been estimated to actually bring in enough resources? I mean, you also see extra income minus time and so on.
I haven't quantified it myself, and I'm not sure if there is an estimate for that. But you are right, these are extremely high. And these are only for the very small firms. So $100,000 firm, a small kiosk. Imagine what is happening. So basically, the tax authority is sitting every year in these larger firms. And therefore, I started with this comment that maybe we should think about an optimal compliance gap. We shouldn't think of having a zero tax evasion. Its enforcement is really costly.
So if there are no other questions or comments, so thanks again, Zareh.
Yeah, thank you very much.